Thank you and welcome everyone to this week's speaker series. I'm very happy to be joined today by Marco Pirondini. Marco, I hope I pronounced your last name correctly.
You pronounced it perfectly.
Okay, so almost like an Italian, but probably not. Anyway, thank you for joining us today. So Marco is the head of Global Equities for Amundi. He manages as well two separate funds. Marco, thank you for joining us. Are you joining us from Europe?
No, I'm joining you from Boston. I've been living in Boston for the last 22 years.
Oh, that's great. That's great. That's great. Well, we love Boston here. Be up there shortly ourselves. So, Marco, before we dive into some of the specifics with the funds and the two different funds that you manage specifically, let's take a step back and look at the sort of broader macro picture. And I want to start with a topic that I think is definitely not getting enough press, I think, but is, as an asset manager, you're an asset manager. We are asset managers. A lot of the FAs here are asset managers. They're having a lot of difficulty this year because, as you know, the broad, especially the US indices are doing quite well. The S&P 500 is up, 8% or so. We're seeing very good performance out of NASDAQ. But what we're really seeing is very narrow breadth to the market, right? I haven't checked the figures as of a few days ago, but as of maybe a week or two ago, 75% of the market performance year to date really was 5 large language model stocks. NVIDIA, Salesforce, Microsoft, Google, those kinds of names that were really sort of driving market performance. And if managers were not involved in those names, they were sort of systematically underperforming the broader index. Tell us a little bit about what are some of your thoughts on this sort of narrowing market breadth. Does it concern you? Is it sustainable? Is it a picture? Is it a sign that actually the market is sort of worried about the growth outlook? So it's only really, the money's being concentrated only among a few names that tend to be more defensively positioned, that have a high exposure to quality. Sort of give us your thoughts on that.
I think that there are several questions in your question. First of all, is it sustainable? The reality is that the market is really concentrated. The concentration in the market peaked 2 years ago in August of 2020 to almost 24% of the S&P 500 being in 5 stocks. Has started to go down in the last 2 years. There was a massive rebound of concentration in the first part of this year. Historically, if you go back 100 years, this has already happened about 6 times. Every time it happened, it normalized over the following 10 or 15 years. And historically, the stocks that are in one peak, they're never the same in the following peak, with a couple of exceptions. Microsoft is an exception. Exxon many years ago was another exception. That tells you that statistically is better when you have these extreme concentrations, because obviously 5 stocks cannot represent a quarter of the American economy. It's better to start to go the other way, be patient, because things will normalize. And will normalize for many reasons, not because these companies are not great. These companies are great, but there is the law of large number. The bigger you are, the more difficult it is to sustain a certain growth rates. So if you are so big and you have multiples that on average are almost twice the market, statistically, if you take a longer term approach to investing, you are very unlikely to come out winning out of this situation. But in the short term, it's very painful. Active managers will tend to suffer this type of situation because they will tend to do better when the equally weighted index does better than the market cap weighted index. And this is the first answer on the sustainability. The second question is this trying to highlight something? Is this trying to tell you something? I think it is. I think that people are very skeptical of this market. They are very afraid about what can be the economic development in the second part of the year. We all know that statistically, when the Fed increases rates so fast and so much, you're going to get into a recession. We all know that statistically, when you have a credit tightening that is as big as the one that we are having right now, you are more likely to get into a recession. So people are afraid of a recession. They're going into this company because these companies have stable businesses and great balance sheet. I think where the mistake is done here is because it's true that you reduce the economic risk by buying this company, but you massively increase your valuation risk.
Mm-hmm.
And I'm not sure you will come out winning.
So you brought up very salient points, many of which I completely agree with, and my statistical brain also leads me to fade this narrowing of breadth in the market. But let me do a pushback there, which is an interesting viewpoint that I've heard. I don't know which way I stand on it, but I would love to hear your thoughts on it. I've heard some commentary to the effect that because this is being driven to a large degree by generative AI investments, and especially these LLM related stocks, that these really are winner take all stocks, because the disruption has to come from the large companies, because it's the large companies that have the capital and the computing prowess to be able to not only build these large language models, but to also sustain them. I mean, the amount of computing power that's required, the amount of GPUs you need is astronomical. So it's very hard for smaller disruptors to come into the space. What's sort of your pushback on that, or what would you say to that? That it is an increasingly winner take all strategy that's happening with these big names?
That is 100% true, but we live in democracies. And usually, historically, we have never allowed one single monopolist to take the whole thing. Otherwise, the telecom company would be the most profitable companies in the world. Instead, we broke them up and we regulated how they could price their service.
Right.
So when you buy a stock, you buy the next 20 or 30 years. You don't buy the next 4 quarters.
Right.
And I think here the problem is in this context. When you have single companies that you're sucking up 100 billion of free cash flow from the entire of the rest economy. If you think that paying 30 times for those type of companies is justified, those companies within not so many years will make 200, 300 billion of free cash. Mm-hmm. And have you seen how much public debt we have and how big is the deficit?
Yes.
You know, why you rob a bank? Because that's where the money is, you know? I think this will have problems that will be shared between.
I think that's a great point. So, right. So you're saying that they have increased regulatory risk, or even potentially breakup risk, right?
Correct.
Well, okay, because I fully agree with you, by the way, on the regulatory risk. How about the breakup risk? Because again, the way that you train these models is on large data, you need to have access to large data. There's a reason why most of the research that's being done nowadays in AI, it's not being done in the universities, it's not being done in academia, it's being done in 2 or 3 research labs, Google's, Microsoft, Baidu, a few others. What are your views on that?
You can regulate how those services are used and priced.
Right.
You remember the old phones? They couldn't make any price they wanted.
Right.
It was regulated. We made a specific authority to regulate the telecom business. Yeah. There will be a regulation of AI, or will be a regulation of how these platforms, you know, you can regulate a lot of things if you want. You can regulate how internet commerce work and how much they can price to the people using the platform. You can regulate another platform like iTunes. We don't really know how it will shape up, but we know that historically we have never allowed single company to accumulate the entire wealth of the economy, no matter how strong was their position. Right. Because we have always assumed that was because of some sort of monopolistic situation, maybe driven by the market, like in this case. But historically we have never allowed this to happen. So always there is an intervention. I'm not saying that this is happening tomorrow. I'm saying that when you buy 30 times earnings, certain types of numbers that are so big, you need to expect that this growth rate can be maintained for decades. And I really struggle to see that.
Yeah, no, those are all very, very good points. So let's sort of switch away from this topic of market breadth. Let's go more to, let's say, a geographical or regional basis. You know, when we started the year, we saw a lot of, let's say, a lot of the market consensus was that US markets were very expensive compared to other markets ex-US. Europe, for example, very cheap. China, very cheap. We've seen, obviously, European markets have had a very strong start to the year, not so much in China. They've given back a lot of those gains already, and now they are underperforming once again. What's your outlook in terms on a regional basis, US versus international markets going forward?
When I'm managing my global asset allocation or my global equity fund, I have this year, I have the largest overweight of international equity relative to US equity that I ever had since I started to manage this fund 12 years ago.
Okay.
We made a big overweight in Europe about 9 months ago. And Europe has been a very strong performance in these last 9 months. We are increasing significantly Japan as we speak, because we have valuations that are 1/3 cheaper than the US, in some cases with very similar companies. Not only, but the economies outside the US are reaccelerating faster than the US, that instead is slowing. And for once, and I think it's the first time that I can say this in the 30 years I've been doing this, the banking sector is in better shape outside the US than in the US, because our banks have really put themselves in a tough position with the bond portfolios, have really lost a lot of money. They will come back with time. But it's not a credit risk, it's just an asset liability issue. But outside the US, this is, nobody has done this mistake. And so they will be way more supportive of the growth of the economy. You are right on China. We are not, I have been skeptical too of China for one obvious reasons. The geopolitical risk is increasing significantly, and is very, very difficult to manage in that context. And we have seen multiple interventions in the economy that are not in the direction of private investments and so on and so forth, including recently limiting the amount of information that can go to foreign investors. But there are other issues, I think, longer term with China. China is, the Chinese population has started to shrink. The working age population in China has started to shrink because of the decades of one-child policy. And this will limit their growth rate going forward after this reopening rebound. And also, half of their GDP, or actually more than half of their GDP, is investments, with a big chunk investments in real estate. And they have a big bubble in real estate. They have these real estate developers that are full of debt and are in intensive care unit, let's call it like that.
Right.
So that part of when you have more than half of your economy that cannot grow, and a shrinking working age population, so it's difficult to see China the growth anywhere near the 5-6% that we have seen in the past decade. I think the growth rate in the next decade will be half that number, if they get lucky. And on the reopening, I was of the opinion that the reopening would have been disappointing for two reasons. One, they never closed the factories. So the factories have continued to produce even when they were in lockdown. They were locking down the workers inside the factory, and they were still shipping to the West. That's the first consideration. The second consideration is that they didn't have helicopter money like we did. So they didn't give money to everybody. So the consumer, after 2 years of lockdown, is very stressed. So they have a rich consumer that is very well off, and they went out and bought LVMH bags. But then they have the normal people that actually are very, very careful with money because they saw their savings going down during COVID.
Right. Okay. And let me ask you this, that point about the demographics, because you're absolutely right. I think one of the surprising developments over the last year has been the latest population reports out of China of how quickly the population is going down. Any sort of view though, in terms of their urban rural population though is still very much skewed towards rural, and there's a reason why we call our labor report in the United States non-farm payrolls, because we understand that we're really talking about urbanized labor is what we care about in terms of productivity specifically. They still have those 600-700 million people that are still in rural areas that still need to be moving over to the cities. Their urban-rural divide is nowhere near. They're not as urbanized as Europe is. They're not as urbanized as the United States is. Do you think, even though in absolute terms they have falling demographics, that urbanization trend though could still continue sort of their pace of growth?
I think so. And I think they will have positive growth. I was talking of half the growth rate of the recent years. That is still a respectable growth rate, but 3% starts to be a very different growth rate than the 8% of 2 decades ago and the 6% of the last decade.
Right.
So it's just significantly lower. That's my that's my point.
Sure. When you do invest in China, how do you invest, or does it depend on what thesis you have? Are you investing in A shares, H shares? Are you investing in proxy markets? We've seen, for example, a lot of people recently, a lot of portfolio managers don't want direct investment exposure in China because of the regulatory risk potentially down the line, but yet they're investing in some markets that they think are good proxies for Chinese growth. How do you manage this?
Honestly, after the Russian experience, is not only regulatory risk, but is also the sanctions. The Biden administration has already forced asset managers to sell a number of stocks. In China, stocks that are deemed, like the telecom companies, that are deemed to be close to the army. So I think most portfolio managers don't want to get caught into any of these. They fundamentally don't think that anything is going to happen in anytime soon, but they don't want to be involved directly. So you're right, and we have been playing that. We had some investments in Korea. We had some investments in Japan. We had some investments in Southeast Asia that are actually with companies that are, or the luxury name in Europe, that are very exposed to the China reopening and have actually done better than the markets because of the China reopening, but without being directly in China.
Exactly. Okay. And before I ask you a couple more questions, Marco, I'd like to remind everyone that if you do have questions for Marco, please submit them either via the chat here or via the chat to me directly, and I'd be happy to share that with him as soon as I get through a couple more questions. I'll just leave it at 2 more questions, Marco, before we move on to some questions from the audience. In terms of style factor, we know for the last 10, 12 years or so, growth factor equities have really, really outperformed. They got very, very expensive relative to value versus their historical means. Last year, there was a massive reversal of that where value outperformed growth quite significantly. But now we've seen that sort of turn again. But yet growth still remains historically expensive to value, right? You seem to mention valuation as a big driver of your decision making, especially in the long term. How are you playing this dynamic between value and growth in your portfolios right now?
I think this is a fantastic investment opportunity, honestly, because 12 years of quantitative easing have sent the real rates to be negative. and had a big impact on asset prices. That was the goal of quantitative easing, to manipulate asset prices by manipulating the long-term rates in the US. And this is exactly what has happened. So long duration assets have outperformed gigantically since basically 2010. And when the US started to get close to switch from quantitative easing to quantitative tightening, immediately all the trends started to reverse. That was last year. This year, you had the Fed and the Treasury have been forced into quantitative easing again. That's because of the window of refinancing that they had to give to the banks, and that's because of the ceiling debate. That ceiling debate, the Treasury is basically not issuing bonds but draining their accounts, and this is equates to creating liquidity. And immediately you had again the same trends of the quantitative easing period. The reality is that the goal, the longer term goal now is to move from quantitative easing to quantitative tightening. As soon as this situation normalizes, we will go back to the quantitative tightening strategy, and this will promote a normalization of relative pricing. There is, as I said, there is a massive overvaluation of anything growth, and anything large cap growth in particular. It's many faces of the same problem. The concentration of the index is because of those stocks. You eliminate 20, 30 stocks from the index, and the US market trades at 13, 14 times exactly like international markets, and it's actually quite attractive here. So I think that all this area where all the overvaluation, the valuation risk is concentrated, will tend to normalize as we move back to quantitative tightening. And I think when we make advice to people, I think it's very, very important to highlight to them these longer term anomalies, because they always normalize.
Okay. Marco, and then last question before I open it up for questions from the audience. What sort of yield alternatives, let's say in dividend paying stocks, can clients be reasonably looking for in this current environment that we're in, where we still have the short end of the Treasury still paying you in the high fours, low fives?
I run an income strategy that is an asset allocation income strategies, and I'm distributing around 5.5–6%. That is pretty much the same distribution that I had for the last 11 years. And the reason is that in the last 11 years it was difficult to find yield. Now the real challenge is to be able to pay that yield without losing capital. Because in this environment, an environment of rising rates, an environment of rationing credit, I think you have to be very, very careful to the downside risk. That's why I'm not stretching out for yield, and I'm maintaining, I think to have 5.5–6% right now is reasonable. It's possible to go higher in certain areas, but I don't think it's a moment where you want to stretch for yield, because there is a high probability that we are somewhere towards the end of a cycle.
Okay, great. So I'll read out some questions, and I'll sort of add some commentary here on one. So one is asking about your sort of expectations for the Fed. Let me preface that question with the following information, which I'm sure you're aware of, but just in case some of our RFAs are not. So last week, so exactly 1 week ago, the market was pricing basically no chance of a Fed rate hike at the June meeting. It was sitting at roughly 2%. If you look at today, you look at Fed funds futures, market's pricing in roughly a third, 33% chance that the Fed raises rates by 25 basis points at the June meeting. Do you think that this is a correct price move in the market? What's your sort of outlook for the Fed, and what is going to be the future path of monetary policy in the United States?
Yeah, I think that the Fed, in terms of raising rates, is done. I think the Fed has peaked, and I really think that the Fed here should take a pause and wait a few months to see the full impact of what they've already done. Because the reality is that nobody knows, and they don't know the full impact of what they've already done. It's playing out slower than normal, the impact on the economy. One of the reasons is that people have refinanced a lot with so many years of low rates. So a lot of people are locked in very low rates and are not feeling the heat of higher rates right away.
Right.
But it's a slow-moving tide. You know, it's like water when it goes up. It looks slow, but then it goes everywhere. And here is the same thing. So the higher rates will continue to flow into the economy. Companies will continue to refinance at higher and higher rates. It will continue to move into their P&L for the next 3 or 4 years. And the same will be with consumers. So I think the Fed should pause and try to understand if they've done enough or not. Where I believe the market is really wrong in expecting a cut fairly early by the end of the year. I think that's really misplaced, because the Fed, I think, will stay at these levels for quite some time. And the reason is simple. Today, the problem is core inflation. Core inflation is well over twice the target of the Fed. And core inflation is the most domestic part of inflation, is the service part of inflation. And the service part of inflation will go down only if you weaken the labor market. The labor market is the last piece of a slowdown. When the economy slows down, the labor market starts to really weaken only after profit weakens. So the Fed, unfortunately, this time will have to do some damage to the economy if they want to slow the inflation. And I don't think they will be early in cutting rates at the first sign of correction in financial markets.
Okay. I think we have time for 2 questions here. What sectors do you like right now?
I like the financial sector, especially outside the US, but also with some opportunities in the US. Has been surprising for American investors, but has been one of the best performing sector year to date outside the US. And between the non-cyclical sector, we find a lot of opportunity in the healthcare space. Devices, pharma, distributors are all very, very interesting. In technology, we like some parts of it. The semiconductors seem to have really already corrected for a year and a half. Maybe now that you are in the middle of all the bad news is the moment to start to accumulate this position. And I think that American natural gas is still a fantastic long-term opportunity.
And then final question here, because we are running out of time, is would you deploy fresh capital into the markets right now, or would you wait? I guess is the tenor of the question. They're asking if you should wait for a more attractive opportunity down the line.
I think that I think you want to have an overall risk stance that is a little bit less than normal. But I think that given the anomalies in the valuation in the market, if you are a stock picker, the majority of the market is actually interesting.
Right.
And the point is that I think that the index is very dangerous. I don't think that the majority of the stocks are very dangerous. If you remember, even in 2000, if you bought the old economy absolutely in the worst possible moment, that was March 2000, you would be making money within 2 years. The overall market, it took a long time before it went back to those levels. What I'm trying to say is that in the short term, everything seems to go up and down together. But in the longer term, there are big differences. And I think that there is a part of the market that has been forgotten, that is very interesting, and is where the valuation are just justified by the dividends, by the buybacks. Companies are disciplined, they have nice cash flow. So I wouldn't go out of the market completely, and I would definitely try to have some positions, some exposures outside the US.
Excellent. Well, Marco, thank you so much. Appreciate you joining us here. Sorry you had to suffer that defeat last night in Boston at the hands of the Miami Heat, but hopefully you weren't hit too badly by that.
We will come back.
What's that? Yes, of course. It's like the market eventually comes back, right? So we need to go to the mean here. So, Marco, thank you so much. We really appreciate your time, and thank you all for joining us this week. We'll see you again next week. Thank you, everyone. Great evening. Insignia Financial Group, LLC comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insignia International Financial Services, LLC, headquartered in Puerto Rico, and through Insignia Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignia Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignia International Asesores de Inversión Uruguay, SA, Insignia Asesores de Inversión Latam, SRL, and Insignia Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignia Argentina, SAU, and in Chile through Insignia Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insignia Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insignia.com/disclosures/ or via www.finra.org. To learn about Insignia Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Advisor Public Disclosures website, https://advisorinfo.sec.gov/.